there is one stock in China that nobody talks about. Yet, it's a better business than what you hear on the news. Alibaba, Tencent, JD.com, all the darlings of the Chinese equity market. So, in this video, we will talk about the Chinese economy, the Chinese stock market, and how you can take advantage of this big opportunity, because we'll do an analysis of these hidden gem of China. And I don't know why there is a lack of information, a lack of clarity around this stock, but when I go on Twitter, when I watch TV, CNBC, nobody talks about this stock. But it's a big company. It's 400 billion market cap, and I don't know, nobody likes this stock. So we have a very strange situation, and this is our job as stock pickers to find these opportunities. So let me go through some slides for you. Okay, the first slide I want to share with you is the fact that Chinese equities go up to the moon. It's a vertical line, and literally in a couple of days, all the Chinese stock market went up. It's only recent. It's maybe 1 week. In 1 week, they went up 30%, 40%. So we see some strong moves. For example, we have here Alibaba. The stock was oscillating between $70 and $80 per share, and now it went from $70 to $110 per share. So that's a very strong move in a very short amount of time, in a couple of days only. Just because I'm sure you're aware of it, it's because of the big stimulus in China, the big bazooka. They reduced their interest rates, they gave some liquidity, they gave some almost free loans to these companies to buy back their shares. So a couple of points, a couple of incentives here and there, and if you add up all the incentives, it boosts the Chinese economy. It boosts the Chinese stock market. So that's why you have this shift in temperament in this market, this shift in sentiment. And we see for a lot of stocks, actually, some spike, some big movement up and to the right. So let me go to the next slide. Yeah, over the past month, this is Alibaba stock price compared to the S&P 500, which is the major index in the US. Literally over the 1 month, the S&P went up 1% and the Alibaba went up 40%. So some big outperformance. That's crazy what is happening. And you see year to date also, Alibaba went from underperforming the index to now outperforming by a huge amount. The S&P 500 is up 20%. Alibaba is up 50%. So that's some big movement, and that's also the reason you see some shift in sentiment. Now they say Chinese equities are good again, outperforming American stocks. But if you take a look at the 5-year performance, that's totally the opposite situation. Yes, over the past months we see some big outperformance, but if we take a long time horizon, that's a different story. That's a complete disaster. So 5 years ago, that's in percentage terms. Yeah, absolutely. So you start from the same price point, let's say, and if you had invested in the S&P 500, you would have had a double. It's almost 100% gain. And if you had invested in Alibaba, you would have lost 30% of your money. So this story is changing, but that's very recent. Just be aware of it. Chinese equities have not always been like in a spike, vertical movement up and to the right. It has been a disaster for the past 5 years. And I have other stocks for you which follow the same scenario. Tencent, which is also a big major in Chinese market, compared to the S&P 500, it's up over the last months, up 26%. Year to date, up 60%, which is great, which is absolutely great. If you had invested at January 1st, you would have made 60% gain. So that's terrific results. And over the last 5 years, again, same scenario. You see some outperformance, underperformance, but after 5 years, you would have been better off investing in a simple ETF. the S&P 500. So I mean, the gap would have been even greater if you had invested in the Nasdaq. But let's stay with the S&P 500, because it's the main index in the US. So again, very recent, but over the long term, Chinese equities don't outperform. And same thing for JD.com over the last months, plus 68%, which is enormous. Year to date, plus 65%. And now it is outperforming, but over the past 5 years, again, underperformance. So that's very recent. Don't get hyped up. That's my message here. The hype is very short term, and that's not the first time the Chinese economy is doing some bazooka stimulus to boost their economy. And we are used to having big spike and then a crash. Big spike and then a crash. So if you are a subscriber of this channel, you know that we invest for the long term in strong companies with moat for at least 3 years, 5 years. So it's good to look at the track record of the company. Don't only look at the 1 week. Don't get hyped by this situation. That's my message here. What I want to talk today is about a company called Quecho Mutai, which is a rather big company. Maybe the market cap is $300 billion, $400 billion. So that's a big company, but still, it is not on the news. When people talk about the Chinese market, they talk about Alibaba, Tencent, PDD, JD.com, but nobody talks about Quecho Mutai. And at the time, a couple of months ago, Quecho Mutai was the biggest company in China. And still, I'm astonished to see the number of people that don't know this company, that are not aware that Quecho Mutai exists. And I think it's the best opportunity in China now. Now, that's the beginning of my pitch. In the following slides, I will explain to you what they do and why I think it's the best opportunity if you want to invest in China. So if you're curious about China and you see the growth and you think it is a beautiful rebound with the stimulus, maybe Alibaba is not the best bet right now. Maybe Tencent is not the best opportunity. Maybe PDD, JD.com, Tencent Music, maybe these are not the best opportunities right now. And I think Quecho Mutai qualify as a top investment, especially if China rebounds. So you will see what I'm talking about. This is the interface of Stock Unlock, by the way, a website that I recommend. And what do they do? Literally, this is your first question, I suppose. Oh no, sorry. That's before that. Your first question should be, okay, show me the performance. I have compared the performance of Quecho Mutai in green, Alibaba in yellow, and Tencent in blue. So I can't show you the percentage, but I can show you the CAGR, the compounded annual growth rate. It is at the top bottom at the right. You see, for Quecho Mutai, it's plus 28% per year for the past 10 years. That's since 2014. So yeah, 10 years. If you had invested in Alibaba 10 years ago, you would have a CAGR of 3%. And if you had invested in Tencent, you would have 16%. So Quecho Mutai has outperformed the two other major companies in China, but nobody knows this company. Okay, let me continue. What do? They sell alcohol, beverage, premium luxury alcohol that is really well known in China. This is the company that you offer. This is the bottle of alcohol that you share, that you gift people, and in a, let's say, professional environment, people send gift of this. Quecho Mutai is aligned with the Chinese culture, is literally part of the Chinese culture. You have a lot of people in China that drink these drinks, these alcohol drink bottles, and it has been the case for decades. Literally, if you ask a Chinese person, I would bet that they know what a Mutai liquor is. And they have different liquors, different bottles that you can see here. But these are expensive bottles. We are talking about, I don't know, a couple of $100s for a bottle, $1,000 for a bottle, like luxury gifts. And again, this simple company, they sell bottles of alcohol. This simple company is outperforming Alibaba, with a powerhouse major company. They are outperforming Tencent, which is a tech major, mobile, WeChat, all these big company, the cloud, the tech heavy. No, this company that sells bottle of alcohol is outperforming other companies, most companies in China actually. And the financials are maybe one of the best financials you will see. You will see in the coming slides. Okay. Obviously, well, this is the stock price of Mutai since the announcement of the big stimulus in China. So yes, over the past months, it's up 24%. Year to date, it's still underperforming. So you can have an arbitrage play to invest in this stock rather than the other ones. And over the past 5 years, again, you see the underperformance. Okay, so same scenario for Chinese equities. So you don't see a major upswing that outperforms the market. What I want to say is Mutai is not more expensive compared to the index. So for JD.com, Tencent, Alibaba, they underperform the index, and they have been underperforming for 5 years. Okay, now let's talk about financials and the quality of the company, because I think this is one of the maybe top 10 companies in the world. In my opinion, that's my opinion, because it's a phenomenal business model. On Stock Unlock, they give you a score to see if the company has good margins, good profitability, good growth, etc. You have a score of 4 out of 5. So, very good score from a finance website. That's a very good sign, I would say. Now, let's talk numbers. This is the revenue since 2004, so 20 years. 20 years of track record. We know in this YouTube channel that we like to analyze companies with a long track record, because we don't rely on short-term trends. If a company has been public for 3 years, it's a short time horizon to see if the management has been good. So now we have 20 years. So that's a long time horizon. And the revenue has been growing 22% per year for 20 years. And you see, there is not much volatility. This is literally either stable or growing. And they don't care about the Chinese crash in 2015 because revenue was stable. They don't care about the housing bubble that is crashing. Revenue is growing. They don't care about COVID. Revenue is growing. They don't care about the lockdowns, the Chinese economy that is dropping, the deflation. They don't care because they have such a strong product entrenched in the Chinese culture that people will continue to buy these bottles. This is literally in their culture, and they are the leader. It's almost a monopoly in the sense of the Moutai, the liquor. They have some competition, but they are not as profitable as them. They are not growing as fast as Mutai. Mutai is the clear leader, and they have an advantage, is they have a liquor that can be produced in a certain land, a kind of land in China, and only in this land. You know what? Mutai is the only player in this land that can produce this kind of alcoholic beverages. So literally, the kind of alcohol they do, only Mutai can do it. So they have a beautiful moat, and nobody can take them away from them. Nobody can disrupt them because they own the land where this alcohol can be made. So you can't copy it. I don't know, maybe Chinese are very smart. Chinese people are very smart, so they will maybe create some synthetic beverage to copy the formula. But for the moment, the moat is just spectacular. Okay, let me continue regarding the financials. So revenue is growing 20% over 20 years. So that's phenomenal. Compare it to other players in the industry, and I bet you can't name a lot of companies that can grow this fast for so long. This is the net income growing 26% per year for 20 years. CAGR of 26% of net income. And you see net income is higher than revenue. So in the meantime, during this 20-year period, you have a margin improvement. Okay, again, can you name 10 companies that have grown net income by 26% per year over 20 years without much volatility? Again. And this is the diluted EPS. So again, 26%. Spoiler alert, they don't do buybacks. They don't do stock insurance. So the number of shares is stable. So net income is literally equal to EPS. Okay, very well. Let me continue. This is the free cash flow per share, in case you were wondering if this is a company that generates a lot of cash. This is more volatile, I agree with you, but still growing. And the CAGR, the compound annual growth rate, is 27%. Again, can you name 10 companies that have grown their free cash flow per share 27% per year annually for 20 years? I can't. Okay, let me continue. This is the balance sheet of the company. Maybe it has a lot of debt, maybe no. In green, you have the total cash. In blue, you have the total debt. So maybe, okay, no. Either year, either any decade you take, any year, they had more cash than debt. So literally, that's not in dollars terms. So I don't know if the cash balance is big or not. I have to check, to double check. You can double check yourself on Stock Unlock, by the way. But yeah, what I want to say is this is not a company with a lot of debt. This is a company with a lot of cash, and they continue to grow 20% per year, which is very, very rare. So they are not boosted by leverage. They don't cheat because of debt, cheap debt, yen debt, denominated in yen from Japan, or they don't do this. They literally grow 20% per year without much debt. So this is purely internal. Okay. And this is the return on equity over 20 years. So you see, this is oscillating, okay, but it is averaging 30%. So return on equity for this company is 30%. This is what you can expect as a shareholder. This is the return on your equity, your money. And okay, now let's talk about the margins. We said before that we saw some margin improvement because revenue was lower than net income. Okay, let's see the margins. We have gross margins. So this is revenue minus cost of goods sold, the cost of producing the bottles, because they do it in-house, the own bottling, the own land, the costs are minimal. This is in-house. They don't work with a lot of other companies. They do everything internally, so that reduces cost, and you have very, very high margins. The gross margins on average are about 80%. That's phenomenal. And if you want to compare these gross margins to other beverage player, alcoholic bottles player, let me compare this gross margin with Diageo in blue and Pernod Ricard in yellow. So on average, you have for Kwashimutai gross margin of 80%. On average for Diageo you have 60%, and for Pernod Ricard you have 60%. So that's a 20% gap, because maybe the pricing power, because maybe they do it in-house internally, because maybe they have no competition, so they can put any number and any price on their bottles and still people will buy it. Maybe because it's entrenched in the Chinese culture, so they can sell a lot of bottles regardless of recessions, etc. They can have a more efficient system in-house. But you see, over 20 years, there is a big gap between our Western alcoholic beverage company and this one. This is a special animal. And now let's talk about the EBIT margin, so operational margins. And you see that the average EBIT margin for this company is 60%. Again, can you name 10 companies with such a high EBIT margin growing 20% per year? It's hard to find 10. Let me continue. This is the net margin averaging 45%. So let's say half of the revenue is translated into profits. Okay, very well. Now I want to show you the capex, the investment, because maybe they do in a house, but maybe they have a lot of investments to grow their bottles. I don't know, but no, actually no. This is the operating cash flow in blue, going up and to the right, and you have the capex in green. If you can't see the capex, that's normal, because the capex is minimal. If you compare the amount of cash that the company generates to the capex, to the investments, reinvestments, maintenance, that's minimal. So literally, to grow and to maintain the operations, it costs almost nothing to the company, and still the company is generating more cash and more cash and more cash and more cash. So you have a very healthy situation. And what do they do with the cash? As I told you, they don't do buybacks. They don't issue shares also. They don't do acquisitions. They almost have zero goodwill, I think. So zero acquisitions. So no M&A, no buybacks. What do you do with the cash? You don't have to repay your debt because you don't have a lot of debt. What they do is very simple: dividends. Dividends, dividends. And over the past few years, all the free cash flow is translated into dividends. So, okay, you see the growth of dividend paid. As free cash flow will grow, dividends will grow. And yeah, this is the dividend yield. It's not that big actually. Now you have average of 2% yield, and the most recent one is 1.2%. So right now the dividend yield is not that big, but like free cash flow will grow. If the stock price stays the same, the yield will grow. And that's the most recent data. But if you look at 2015, the dividend yield was superior to 3%, 4%. So that can be interesting if you are a dividend investor. And if you want to do your analysis yourself like this, I have a coaching program. There is a link in the description. If you want to apply, you can book a call with me. You can discuss your investments, your goals, your objectives. And if you also want to find these hidden gems, these opportunities, do your analysis to improve your stock portfolio, improve your returns, I have a coaching program. So this is maybe the first link in the description. You can book a call with me and we will see if we can work together. Okay, now let's talk valuation, because I said, okay, this is the best business in the world, excellent moat, nobody can touch them, free cash flow, a lot of cash, zero debt, healthy margins that destroy competition. What about the price? Is it priced at a premium, at a price that is so high that you have a strange risk reward? No. This is the PE ratio for the past 20 years. You see the bubble of 2008. So the PE went to 75 and then it crashed, and then in 2010, 11, 12, 13 it decreased. In 2013 you had a PE ratio of 10 if you wanted to buy this growing business, and then it went up during COVID 2020, 2021 to a PE of 60, which was quite expensive. And since then the valuation has decreased, and now the PE ratio is around 25, 27, 28, these kind of things. I see this as quite cheap actually. It's not extremely cheap, but for the quality of business that this is, I see this as one of the best risk reward in the market. Valuation has decreased because earnings have continued to grow, but the stock price has been stable. So okay, maybe I can show you the stock price over time. Let me check. Okay, so you see this is the past slide, the comparison with the S&P 500. So you see in 2020 that the stock price went up, this is in green, and then 2021, 2022, 23, 24, the stock price went nowhere or declined. But as the stock price was declining, EPS went up and went up and went up. So that's the reason why you see a big drop in PE ratio. Let me go back to the slide about PE ratio. Yeah, that's the reason you went from a PE ratio of 60, which was expensive, to now 25. So yeah, you cut in half the valuation, and now it's reasonably priced. And if you want to compare the price to free cash flow, that's very similar. You have a big bubble in 2007, and then it went back down, and now it's oscillating, and now the price to free cash flow is 30. Yeah, approximately net income is equal to free cash flow. That's approximately the same. But you have a business trading between valuation between 25 and 30. 30 times earnings. And I have put on Stock Unlock again a DCF to see, okay, what the earnings will look like in the next 5 years. If earnings grow 15% per year for the next 5 years, remember that the earnings were not growing 15%, they grew like 26% per year on average. So okay, let's average down. Let's say they will grow 15% per year for the next 5 years. If we say zero buybacks, I don't know why it is bugging, but I couldn't put a dividend here, but I have to add it back. But you have dividend equals 0. Okay. In case we have zero buybacks, zero dividends, earning growing 15%, and a PE ratio of 25, then the stock is undervalued. You see at the bottom, fair value plus 14.39%, and the expected CAGR, so returns you could get on an annual basis if you invest right now, if you have these assumptions, you can get 13%, which is better than the averages, which is better than the S&P 500 on average. So, and that's on a conservative level. I mean, earnings can grow more than 15%, 18%, 20%, 21, 26. And also you have to add back the dividends that are going to be paid as free cash flow grows. So to be conservative, you are undervalued. So if you are more aggressive, I don't know your risk tolerance, but if you want to play more aggressively, the upside is even higher. And I encourage you to continue your due diligence, your analysis, because this is some extremely good entry point for somebody who is interested in China. And yeah, okay, so if earnings continue to grow 15% per year, this is what the chart will look like for earnings. Sounds reasonable to me. That was my pitch in case you were interested in Kwechumutai. So yeah, to sum up this big slide, be cautious about this Chinese rebound. This is not the first time we have a spike in stock prices for China because of news, etc. And I would advise you to look at other companies. Don't just look at Alibaba, Tencent, JD.com. These are the major players, but you have other players that are as good or better. And I think Kwechumutai is a better investment opportunity right now. Again, this is not financial advice, but this is just my opinion.